Welcome everybody, this is Tom Long. This is our final webinar of the evening. We do have 7 for tomorrow, but tonight is Developing a Trader's Mindset, the Psychology of Trading, which is kind of a strange subject because it's not a subject that a lot of new traders want to delve in. But as you get more involved in trading, you realize that this is really more important than anything else you can learn more about or deal with or become familiar with, and really any other factor in your trading. And I know Greg had mentioned a few minutes before we're having some serious weather here. We've got some heavy winds, and right now we've got some freezing rain coming down. Nice combination. And it is kind of wreaking a little bit of havoc on some of our technology, but we'll get through this fine. And but really this is really what trading is all about. You know, if trading was just a matter of putting on a trade and then immediately taking it off with a profit or a loss, you would have a lot more successful traders. If you're like looking back at historical data and you could see, well, you know, this trade would have done this, this trade would have done that. It's very easy. I don't want to say it's very easy, but it's easier to find an approach to trading that actually works. And I had mentioned before in one of the webinars that the real key is it workable? Is it doable? And I mean that by 2 steps. Number one, can the trader actually execute the entries and exits similar to the way the approach shows in backtesting? And number two, you know, is it just feasible with the market's movement? Is it feasible to get in and out just like you can historically? But today we want to deal with what we bring to the table, with what, you know, emotionally and fundamentally and psychologically our thought process as we go through identifying trades and really taking advantage of them at the same time. And of course, the next slide, as always, is going to touch upon this, and that is our risk disclaimer. That once again, this is a speculative investment. This is high risk because of the leverage. You know, just because it offers some great rewards does not mean that everybody's guaranteed to be rewarded. Big reward comes with big risk. There's just no way around it. That's just the way life works. Life is a balance. You can't identify happiness without having experienced sadness, and so on and so forth. And you just really can't be a winning trader until you first learn how to lose gracefully. That's just the nature of the game. There's no way around it. We can minimize it, but there's just no way around it. We have to learn how to deal with markets moving against us. We have to learn how to deal with our own demons. You know, one of the things that trading forces us to do is to really look in a mirror and see who we are as a person, our personality traits, our strengths, and our weaknesses. And now, a lot of people just aren't ready for, you know, for doing something like that. They just want to accentuate the positive and just eliminate the negative, and that's fine. But as traders, we have to really look into our negatives and learn how to minimize them, how to deal with them, how to incorporate them into our thought process instead of letting them take over our thought process. Now, in part 1, we're going to explore money management principles. We've talked about this. This is one of the big keys to trading. Number 2, techniques for managing our emotions. It can be done, but until we learn how to do this, we are going to be susceptible to those fear and the greed. And as soon as that, again, as soon as that works our way into our decision-making process, we are no longer trading. We want to act on facts and reality. And how the desire to be right can cloud rational thought. That is huge. And there's a couple other things, you know, we want to talk about. I mean, these are well written about, well covered, well documented. But reading about it and hearing about it is very, very different from experiencing it. Just like anything else in life, you can read and you prepare for anything in life, but until you really experience it, you really don't know how you're going to react to the situation, what it is that you're going to do. In part 2, we're going to view some live charts, and we're going to look at some thought process here on an approach that we will cover in more detail tomorrow on high probability trading. but we're going to talk about an approach to trading and some trades that are happening right now or just setting up, and what it is that could mess up our approach, because that's what we want to be zoned in on. Now, a breakdown of a winning trading strategy is not just the trading strategy itself. It'd be nice if it was. It would be nice if we just identify an approach to trading and just execute, but it really doesn't work that way. An exit and an entrance strategy, otherwise our strategy on getting into a trade, is important, but most traders will tell you that the exit strategy is far more important, and that's very, very true. And of course, half of it is winning psychology. You can break that down into confidence in your approach, being aggressive when the time comes, not letting a few losing trades change your approach, and so on and so forth. And we're going to cover those, but this is really what it is that we want to deal with. And identifying that perfect entry, while a worthy goal, is fleeting. I mean, it is a moving target, and we're just not going to find perfect entries that lead to winning trades every time. But that's okay. We don't have to. We just have to be right more often than we're wrong, or make more when we're right than we lose when we're wrong, and we can be successful traders. There are some traders out there who are incredibly successful for decades, but they win about 1 out of 3 trades. The question is, do we have the wherewithal? Do we have the mental strength to be able to use an approach like that and still realize the same profits that these traders have? Until you can answer that question, you cannot move up to the next level of trading. Now, I call it robotic. Traders will tell you, successful traders will tell you, it could be one of the most boring things that they do is trading. It's a lot more fun, taking the money out of your account and putting it into the bank or something, or making the money. But the actual trading process itself can be very, very boring because they've done the same thing over and over again. You see this, you do that. You see that, you do this. Number 2, repeat. Repeat number 1. I mean, that really is what trading is all about. We hear of a lot of new traders who come in because it's exciting. They want to come in and they're excited, with the idea of trading. So they get in there and they buy and they sell and they buy and they sell, and next thing you know, there's no money left. And it was very exciting though, but nowhere in there did they say that they wanted to be a profitable trader, because sometimes excitement and profitability are enemies. They're at the opposite ends of the extreme. We want to be aware of that, and we want to deal with it, and we want to be very, very clear about what it is that we're looking for in the market, because until you can sit down and say, this is exactly what I want from the market, you cannot get it. If your goal is for fun, well, that's great, but for fun, I don't remember hearing the word profitable in there at all. So just be aware of that, and we're going to get into more of that a little bit later on. But money management, of course, what we just talked about, only trade with risk capital. There's an old saying in trading that scared money never wins, and it's so, so true. Otherwise, if you've got some money in an account and you can't afford to lose that money, but you need more than that, you're really setting yourself up for disaster. If you cannot be detached from the outcome of this trade, your chances of winning the trade are really, really low. I mean, it really works opposite. We had a couple of gentlemen talking about golf here. And the golf swing, they say the same thing. If what you're doing feels right, it's probably wrong, because the golf swing is not really about muscle. It's about leverage, just like on trading. And it's not totally about upper body strength, but it's really about the lower body strength. I mean, it's really the opposite of what we think. To be a successful golfer, we have to kind of let go of those things that we think are necessary to hit the ball a long way, and do what really is opposite, just surrender to certain things in order to move up to the next level of golf. Well, trading is exactly the same way. If what you're doing feels right, take another look at it to make sure it indeed is right, because feeling right or feeling wrong is very nice for our own, for ourselves, for our own, mental well-being, but does it lead to profitable trading? That's why we're here, and that's the question we have to ask ourselves. Never place more than 5% of your account at risk. Very, very big. Now, whether that is opening one trade at a time and risking 5% of your account balance, that's fine. Or if you like multiple trades, many professionals, many hedge fund managers, money managers will trade or risk no more than 1% of their account balance on any one trading idea, and thereby they have the ability to open maybe 5 trades at a time. But we really have to identify that risk, keep that risk small, and really stick to it. I mean, there is really no way around it. As soon as you pick up that risk, you are opening yourself up to bigger losses. And I mean, there is really no way around that. I think I had mentioned before, where I've had some new traders tell me, so what's your money management approach? Well, I never intend on losing, so I really don't need one. And I know darn well that it's not going to take long before I hear from them again saying, okay, what was that again you were telling me? Because that is not a money management approach. You know, that is just a pipe dream. And it doesn't take long for the market to realize that that's what you're looking for, and it will do whatever it can to press your buttons, to make you feel uncomfortable, to make you feel vulnerable. Scared money never wins. Only money that you're okay with losing has a chance to win. Okay? Begin by trading small. I mean, we talked about that a couple of times tonight. And we're trying to help you in that process, to where if you're going to learn the software, maybe a little bit about the product that you're trading, that's what the demo account is for. But if you're going to learn about trading, it's got to be with real funds, because that brings in so many more factors, so many more levels of misunderstanding or just keys to successful trading. But when you're going live, not only is it okay, but it's preferable that you start small, give yourself a chance to build up. Okay, the markets will be there tomorrow, and if not, it won't matter anyway. But just we want to begin by trading live funds, begin by trading small. I mean, it's one of the reasons why we're offering small accounts to traders, to people who are coming into this boot camp, because we want to promote when you're going live to trade small. Now, eventually you're going to find where you have some sort of momentum going. And then it's okay to get larger. But that means having a larger trading account, because you never again want to risk more than 5% of your account at any one time. You set your risk reward parameters before entering the trade, and I think I talked about this in my previous webinar. Before you get in, know where you're going to get out. Because once you are in, you are not using technical analysis or cold hard analysis to determine your entry. You are determining your exit by how you feel. And how you feel will be determined by fear and greed. And that is not the way you want to manage your trade. I mean, there's I feel a certain amount of empowerment knowing where I'm going to get out with a loss before I get into the trade. That is one decision that I don't have to make. And I'm okay with if the market moves and stops me out. Am I happy about it? Of course. You don't have to be happy about it, but you have to be okay with it, because I know that in the long run, I've got the numbers on my side. I talk about the coin toss, and I'm not going to talk about the coin toss again. I will thank Greg later on for sharing my story. No, I'm just kidding. But but I know, and Greg knows, and Richard and Dan, I mean, by being, traders over a long period of time, we know that our strength is in consistency and discipline. We see this, we do that. We see that, we do this, time and time again. As long as we don't deviate from the plan, we know that in the long run, the plan will reward us. And that's the level you have to get to in order to be a successful trader. Concerned about the size of the trade? Probably too big. Not probably, definitely too big. If you're going to bed at night and you've got positions open and you're really concerned about how much you can lose, that you can hardly sleep, you've got too much at risk. Okay? Losing 5% of your account balance can sometimes knock you for a little loop. Losing more than that can just knock you right out of the game. There's a difference. There is a big difference. Okay? I know that if I lose 5% of my account balance, that I am one trade away from getting that 5% back and getting 5% more, because I'm using that 1 to 2 risk reward ratio. I'm risking 5%, but I'm looking for 10%. Okay? Very, very aggressive. But we are here for speculation. But it's very aggressive, but it's a risk that I'm willing to take, and I know in the long run that I'll be okay. Because obviously, if I lose 3 or 4 trades in a row, my actual dollar amount of risk will go down because my account size go down, and I'm still risking 5% of that account balance. I am maintaining that no matter what. When in doubt, don't. Or the old saying in the financial markets, when in doubt, get on out. And really, it is very, very true. If you have any doubts about what you're doing, that is your subconscious saying, don't do it. Listen to it. You want to have total confidence in what it is that you're doing so you can be aggressive. Because, many times traders will have a good approach to trading, lose a couple of trades in a row, and then on the third one they say, well, I'm just going to watch this one, see what happens, and I'll pick it up again in the next trade. And of course, what happens? The market senses that it can punish you, and it turns out to be maybe the trade of the month or whatever the situation. And you missed out, and now you're kicking yourself for losing 2 trades, but you're kicking yourself even more for watching a great trade set up and go just as you had hoped it would, and you not taking advantage. Sometimes a missed opportunity can hurt a lot more than a losing trade. So, but we want to be consistent and disciplined in an approach that we're comfortable with. I mean, those are big words, but we've got to get to that level in order to be a successful trader. Limiting and eliminating emotions. The more experience you have, the less emotion you will feel. And that's probably true, because if you're still letting your emotions take over your decision-making process, experience is something that you're not going to get, because you really have to be detached in order to be successful. I like to call it, we have to learn how to lose gracefully. Okay, I mean, it's inevitable. Losing trades are inevitable. And I don't know if any of you have seen the movie A Good Year. Albert Finney and Russell Crowe. It's when Russell Crowe is a boy in France at his uncle's winery in France, and they're playing tennis, and the uncle beats his nephew because he's not going to lose to him intentionally. He's not going to give him a false sense of security. You've got to earn your victories in life. And of course the nephew, being about 12 or 13, is very emotional about his loss, and his uncle comes up with one of the great lines I think about trading is, losing is inevitable. The trick is not to make a habit of it. So if you listen to that movie, it is nothing but one trading piece of advice after another that is very solid, and then you can understand why this character in the movie grows up to be the most successful trader in London. So that is something that I have written down. Losing is inevitable. The trick is not to make a habit of it. Become an automaton. When I see this, I do that. I mean, it really sounds boring, and it really sounds we're being flippant, but as a matter of fact, that's exactly what it is we want to do. We want to be ready to take advantage of a situation that we see is in our favor. And our favor just may be that it turns out that we win 50% of the time. But if we can realize a 1 to 2 risk-reward ratio, we can be incredibly profitable over a period of time. I mean, that is really the key. My colleague Gregory McLeod just mentioned in that last that, if you're using a 1 to 2 risk-reward ratio and you're really a stickler of that, 1 out of 3 trades, winning 1 out of 3 trades means you're a break-even trader. And you've got to get to that level, being a break-even trader, before you can be consistently profitable. But you've got to line up all these situations, and money management, the things that we're talking about here, are bigger than how you identify your entry into a trade. Each trade is just going to be one of 1,000, hopefully, trades you make during your trading career. Hopefully it lasts that long to where you finally find a flow and you stick with it, and you become a stickler for being consistent in that approach. And it's just going to be one trade. And I used to feel the same way when I was starting out, that if I had a losing trade, it meant I didn't know what I was doing. Some people are harder than themselves, and unless they win every trade, they think they're stupid, and they just don't have the wherewithal to do this. Nothing could be further from the truth, okay? Like I said, some of the most smartest people that you'll ever meet, and some of the most successful traders, lose more trades than they win. but yet they've been trading for 30 years and they've made an incredible amount of money for themselves and for their clients. And it's got nothing to do with that. It is not a one trade and done career. You can make it that way, but let's hope that doesn't happen. But this is, like I mentioned before, this is a long-term proposition, not a short-term get-rich-quick scheme. No emotion attached to any trade. This is something that I find that I don't want to use the word struggle, but every once in a while that those demons will start to sit on my shoulder and start to make themselves heard. Tom, get out. The market's moving against you. Get out now. Lock in that profit. It's a nice profit. Lock it in now. And it's been a long time since I've done that, but I will guarantee you the last time I did it, the market turned around and moved right back up to my profit target. Thereby, what I did was mess with the trade, and I lost money because of that. So really don't get into that game. But it is a game, and I want to tell you here that is the most difficult part about the trading, is keeping your hands off and sticking to the plan. Another old saying in the financial markets is plan your trade, trade your plan. Everything else is just a waste of time. Use a tested plan in which you have confidence. Now, I'm not going to sit here and say that this is very easy. It's not. But really, identifying strong trends, trading in the direction of the trend, and using money management, just doing those three things alone will put you in the top 50% of the traders. And automatically you've got a chance. And tomorrow we're going to get more technical for you. We're going to talk about specifics about, getting in and out of trades and technically what to use. And if we've got a chance, we're going to talk about just a little bit here to kind of give you a little idea of what it is we're going to be talking about. But once you identify that approach to trading that has been proven to work, your job is to do it. I do have a little sign here on my desk, and it says it's the process, not the profits. Okay? Because that's just to remind myself, even after all this time, I just want to remind myself that I have a plan. I need to stick to the plan. And today it may not work, but in the long run, I'm going to be better off. You just have to have that confidence, that long-term outlook about if I just stick to what it is that I know that works, time is my friend and it doesn't work against me. Not an easy thing, but it is necessary to move up to the next level. Have a technical and a fundamental reason to enter the trade. Those are really only the two reasons we should have, whether you're just a technical analyst or you like the fundamentals. Okay, you got to have a reason to enter the trade, and a reason to enter a trade is not because I'm bored, because I'm ready, because it's Monday and I want to start off the week with a trade. Those are not reasons to get into a trade. A market moving up through resistance, down through support, those are reasons to enter trade. The non-farm payrolls was stronger than what I thought, and the market's taking it. Those are reasons to enter a trade. But, not because, I haven't had a trade in 3 days and I'm ready. Or you're in a trade and the market's kind of moving sideways, you're getting out because you're bored. That's not a reason to exit a trade either. Avoid trading on knee-jerk reactions. This is going to be a big one. You're going to see Friday, if you are out at 8:30 Eastern, the non-farm payroll, you'll see some big moves. And too many traders get caught up into that. And most of your professional traders will avoid those. There's a reason those markets move a great period, or a large amount in a small period of time, and that is because the big traders aren't playing. There is nothing but space, between the small traders who are trying to figure out which way the market's going to move based on the news release and take advantage of it. Well, more than likely, that volatility is going to take advantage of you. Write your trading plan out. Now this is actually bigger than it sounds. Like I had mentioned before, for those of you who were in the first, that I'm originally from Chicago, which means that I was more in tune to the futures markets and the options exchange than I was in the stock markets of New York. Now, the Chicago Board of Trade when new traders would go down there, traders who were going to trade in the pits, they would have mentors, meaning experienced traders. It was in their best interest to help the new traders along to protect the integrity of the game. So, and one of the traders used to ask that traders, they would hand out 3x5 cards and say, write down your approach to trading. And they would all write it down. Some would use the front, and then on the back they would write, and some would need 2 cards. And they would save them, and after 6 months they would look. And true story, they would look, and they found that the traders who were able to write their approach to trading very clear, very concise, very simple, on the front of the 3x5 card had a better chance of being around after 6 months than the traders who needed more space to write. Okay, particularly the ones who use multiple cards. Very few of them would stick around. Why? It's because the simple approach can withstand the test of time. The more information you use in identifying your entry into the trade, the better chance of it is that you're doing what's called over-optimizing. You're looking at a small period of time and developing an approach that was dependent on what happened maybe in a 2 or 3 month period. Okay? The traders who had a simplified approach knew that if the approach worked 30, 40, 50 years ago and it's working now, obviously this is something that you want to take hold of. Okay? You want to keep, you want to get better at. So keep your approach simple. I'm not saying easy, but simple. If you can eliminate the emotions, now you've moved potentially from simple to easy. But that's a very, very difficult step. But keep it simple. Don't wait for 2 dozen indicators to line up before you get into a trade, because you're going to sit there and wait and wait and wait and wait and wait, and the trade's never going to line up. And when one finally does, if it's a losing trade, you're going to throw it away and you're going to try to develop a new approach. Okay? Stick with some simple rules, and tomorrow we'll have some good ones for you. Keep a trading journal. I think I talked about this a little bit with the report from the trading station that was available. This is a lot bigger than people realize. I mean, I will write down what I was thinking, what was going on every trade I take. And when I go back at the end of the month, when I go back and look at all the trades that I took for the month, I will look at the charts, I will look at what I wrote, and you can learn more from this information than you can from any book, from any indicator, and frankly from any webinar. You can learn more about yourself and your strengths and weaknesses by doing this. So I really recommend that you do this, is just to write down more or less why you got in or why you got out of the trade. Okay, because a lot of times you'll go back and you'll see, boy, the market kept going after I got out. Why did I get out? Oh, I got out because, oh, I remember that. I got out because I was bored, because I didn't think the market was going to move anymore and I didn't want to lose. Wrong answer. Okay, you need to see that, you need to face it, and you need to deal with it. Always. Trade the facts, not emotions. Emotions are natural, human reactions, but we need to hold them in check when trading. We need to hold them more in check when trading. We need to eliminate them completely from our decision-making process. And fear and greed are 2 of the strongest emotions that there are. Most of the governments that we see around the world are based either on fear or greed. The government system that countries use, most of them are based on one or the other, some on both. But we certainly want to keep that out of our trading. We want to be mechanical in nature and robotic. I mean, it doesn't sound fun, but remember, being in it for the fun was secondary. Being in it to be consistently profitable should be the primary reason why we're in these markets. Don't enter a trade hoping that it will move the right way. It won't. The hoping and wishing and praying, I mean, they're all great, and they're used in the markets as much as anywhere else, but they really don't help at all. And what we want to do is, like I mentioned before, use cold analysis, hard, honest analysis, whether it's technical analysis or fundamental analysis. I use technical analysis, and I'm always aware of the fundamentals, particularly because sometimes I'll trade in the longer term chart, and I want to know why that oil chart is moving straight down. Sometimes it doesn't matter, particularly on the shorter term, But on the long term, I want to know why so I can recognize a potential change when it's playing its way out. Don't enter a trade out of fear that you will miss out on a move. This is huge. If you wanted to, say, sell on a market as it moved down through resistance, and it happened, but it's 20 to 30 pips below, and it's moving, don't chase it. Do not chase it, because that is just really not a habit that we want to get into. You can place an entry order in there if the market were to come back, or you move on to the next trading opportunity. But we don't want to chase fast-moving markets. That really very rarely works out. And like I said, the market is more than just a living, breathing thing. It knows us personally, each and every one of us, and it will do whatever it can to punish us for making wrong decisions. Don't enter a trade because of the good feeling you have when you were in a trade. Like I said, if that's why you're in the markets, that's fine, but tell yourself that up front. And don't be upset when you have losing trades. Because you really want to be honest with what it is that you're doing, and commit to that. Just commit to it. But I need to get into a trade because I'm bored, I need to have some fun, that's fine. But don't be too upset if you're not a profitable trader, because nowhere in that sentence did you say that I need to take solid trading opportunities and and be consistent and disciplined in my approach so I can be a profitable trader. Phrases to look out for. Price just can't go any lower and higher. Well, guess what? It can. And yeah, Jason says, and don't gamble. Absolutely. You can gamble, but you realize what gambling really is? It's just placing a bet when you don't know what the outcome is. Now, we don't know what the outcome is either, but we know that over the long term that the outcome is going to be in our favor. You don't get that with gambling. Okay? We want to use analysis, and prices can't go any lower and higher unless it's zero, that they cannot. And there have been many, many examples of prices that can go higher and can go lower. I'll use gold when it broke out of the $400 range and just never looked back until it was like 4 or 5 times that. And or oil, they said, well, we'll never see oil really below 100. Then when it went below 100, we'll never see oil below 75. Then it went below 75. And now we're talking about we could see oil at 25. What happened to all those people that said we could never go below 100? Markets can and will go lower and higher. As a matter of fact, that's one thing we're going to talk about here in a minute, and we're going to expand on tomorrow, is we've got to, most profitable traders will get in on breakouts. Otherwise, they buy new highs and they sell new lows. A lot of new traders just can't force themselves to do that. They like to buy low and sell high. Well, I'm here to tell you that there are more traders who are making money by buying high and selling higher, or selling low and buying lower, okay, on breakouts. We're going to talk about that here in a minute, but you've got to have faith that market can go to new highs or go to new lows, because you know what? Markets do that all the time. After the, we'll say, non-farm payroll release, price will go up or down. When people ask me, how do you trade news releases, I say, you avoid them. And not being in the market is a trading decision. And people say, well, I think the number's going to be weak. And I say, well, what's the market going to do? Well, if the number's weak, the market will go down. So then they watch the announcement, the market is weak, or the release is weak, but the market does the opposite. Okay? Predicting what that number is going to be is very, very different than predicting how the market's going to react. You have no idea whether traders all week long have been positioning themselves up for a weak release. And if the release was weak, but is not as weak as they thought, they're going to react opposite to what you think. So be very, very careful about if you think non-farm payroll is going to be strong and that the dollar should rally. Be very, very careful, because there are professionals out there who have specific numbers in mind and you don't know what it is. They're not necessarily sharing it with you. Oh, they'll throw numbers out, but they're not going to share with you their inner secrets. But it may not be as weak or as strong as they thought, and they will react opposite to what you think should be the obvious move. I mean, I've heard it from experienced traders. The market doesn't know what it's doing. It should be going down. Excuse me. Here's a phrase that not to look out for, but it's true. The market is never wrong. Our interpretation can be often wrong. Price is approaching my stop. I better move it a little. Well, you better be moving it to lower your risk and not widening your risk. But I see traders do this. And once you identify your initial protective stop, remember I've mentioned before, I have a feeling of empowerment where I know I'm going to get out in the worst case scenario. And I'm okay with that. I don't like it. It's not like I come out whistling and skipping, when that happens, but I'm willing to accept that as a trader. I'm willing to accept it. But if the market is moving down to my stop, I don't want to move it further away so I don't get stopped out of the trade. I want to accept that risk and take it. And that's fine, and that's okay. And Greg mentioned something before. I see we have a few females in here, and he's right about one thing, and that's something that we talk about a lot. As sometimes women turn out to be better traders than men because as guys sometimes we get into that I'll show them kind of mentality. And guys, you know what I'm talking about. Sometimes we call it revenge trading. We were wrong on a trade. Now we're going to get back and we're going to show these markets who's who. And next thing you know, we've got 2 losing trades in a row. And where women can be sometimes more flexible. Now this is just in a big. Each of us are different in many different ways. But sometimes women can be a little bit more flexible in their approach on being right or wrong. So not that I'm going to say here that we should be more like women. We just need to be more like professional traders, because obviously many men have gotten to that point where they've surrendered to the fact that they're not going to be right every time. And they know that if they've lost 2 or 3 in a row, they're just closer to that next winning trade, and they get excited about that possibility. I know this trade is going to be the trade of a lifetime. I'm going to load up. And this is when I say when the market can hear you say that. And even if you don't say it out loud, the market can hear you say that, and it really has a tendency to know when we're vulnerable. And if you don't believe me, go ahead and try it once. And it will, and the worst thing that could happen is if you try it once and it works, because now you're convinced that you're brilliant. I'm going to do it again. Well, getting it 2 times in a row, the odds start diminishing, And I've seen and heard of traders who have really loaded up and won 2 or 3 in a row and are really doing well, and then they lose it all on the 4th or 5th trade down the road. Let's not get into that habit. Again, let's think of this as a long-term goal or a long-term process rather than a short-term. The bottom line, we want to enter trades based on what the market is doing, not what we think the market should be doing. Facts, not feeling. I like to call a trade as to sit there and think of the market as a train. If the train is moving westbound and we want to go west, jump on that train and hang on for as long as we can. If the train is moving eastbound, we want to go west, don't jump on an eastbound train thinking, well, it's going to stop pretty soon and turn around. Who says it's going to stop pretty soon? We can only identify where the market is trading up to the point where we hit that entry. Okay? We want to use that information in our decision-making process, and we call that identifying the trend and trading in the direction of that trend. But I've seen new traders tell me, Tom, I think the market's going to move down to this level and then move up here and then reverse, and that's when I'm going to get in. I'm going, wow, not only are you predicting 1 reversal point, but you're predicting 2. So now you've made it twice as impossible to be correct. Don't get into that game. There is no way we can know where support or resistance is going to play out. I mean, we can take educated guesses, but that doesn't mean we're going to be right. Identify the trend, find the strongest trends to trade, and take advantage of those trends. The desire to be right, and it's a big one, it clouds our rational, emotionless thought process. And like I said, you got to get past the fact that if you have 2 or 3 trades in a row, it doesn't mean that you're not cut out to be a trader. Okay? You may not be cut out to be a trader, but it's got nothing to do with the fact that you had 2 or 3 losing trades in a row. It may have something to do with the fact that you bought into the fact that you're not cut out to be a trader. Okay? Maybe you just need to work on your approach to trading, work on your money management, but the matter of the fact, you can't win every time. It can cause us to exit winning trades too soon. Very often it can cause us to do that, and we've talked about that, you know, on through the evening. Is that, you know, if the market's, we got a profitable trade but it's starting to move, you know, against us, don't jump in there before you've got a plan that says to get out at this level, and don't get out too early because you want to not want to let that winner turn into a loser, because now you're skewing your risk reward ratio. Okay, you're never giving yourself a chance to get that 2 times profit that you're of your risk. You've got to have the ability to stay in the trade to see those big gains, because those are the ones that are going to keep you in the game. It can cause us to stay in losing trades too long. You know, it's like a song, wishing and hoping and praying that the market's going to turn around, and that's what the mental stop is. It moves down and we say, well, I'll wait for it to move down a little bit lower and see what happens. And it moves down a little bit lower and I say, well, I'll wait for it to move just back to break even. I'm not going to be a pig here. I'll wait for it to go back to break even, and then I'll get in and just, you know, have a break even trade. And the market continues to move against us until we're introduced to the margin watcher feature of the platform that we're trading. Don't get into that. And Steve says, how much do banks have influence on traders? Well, some of the biggest traders in the world happen to work for banks, Steve, but remember, the bigger a trader is, the more size they're throwing around, the slower that they have to scale in and out as to not make the markets just dramatically move. We have the advantage of being small traders, and we can get in and out quickly. Okay, think of them as the elephants and us as the mice. We can do figure eights through their feet and, you know, take advantage of what we see. So it has a big influence on us, but we can make that a good influence instead of a bad influence. Thank you. Remember, I can do everything right and still have a losing trade. No, remember this. You will do everything right and you will have losing trades. But how you react to those and how you deal with them really is a big, big factor in your long-term success or failure. If I enter a trade precisely according to my plan and get stopped out, I was still right. You better believe it. And this is one that's, it's hard for people to get their arms around, you know, this process, but that is in fact the truth. A trade can be a losing trade and I can still be right. I think we've covered that. Absolutely. And focus on the execution of the trade, not its result. Like my little sign here says right here, it's the process, not the profits. That is the mindset that we do need to have. And we want 4 outcomes in our trades. A small winning trade, a large winning trade, a break-even trade, or a small losing trade. It's those large losing trades that can knock us out of the game. Let me take about 2 minutes here and let's look at some charts, because I want to show you some examples, and we're going to be talking about this more tomorrow, but I've got some examples here of strong trends and what's called the ABC moves, and move back up and then move back down through the low. So we enter, this is a daily chart of the euro dollar, we enter as the market moves down through support, we place our protective stop up above the high in between those 2 lows, and we place our profit target at twice our risk. And we walk away from it, okay? Now you can see where you can get into that if the market starts moving in a direction and starts to turn around, that you're really going to want to, you know, get out a little bit early to protect that profit. Don't do it. Don't do it, because you should know that in the long run, by staying in and waiting for that market to hit your profit target, number one, you're going to get a certain percentage of them that do, and number two, you're going to see that those are the gains that are going to absorb all those losing trades that you've had and keep you in the game. This is on a daily chart. Here's an example on we're going to talk about more specifically this approach that I'm using right here, that what we're called our classic ABC moves. And here's an example here that you can see that the market hasn't quite hit that target and is starting to move up. Let it go. It's fine. Just let it go. And finally, as we get into a more shorter term, we can see the market moving up. This one just kicked off. The entry was above this high. Again, buy high, sell higher, or like those 2 euro trades, sell low, buy lower, and place our protective stop below this 90 level. We know our risk. Our protective stop is in the trade. We just multiply that by 2, okay? It is the risk, our placement of our protective stop, that we're using technical analysis. We're just hoping the trend takes, oh, I said hope, but that's okay. But that's because it doesn't always do it. But it's because we're trading into trend gives us the audacity to look in twice in risk, or twice in profit, that we're willing to risk on the trade. Okay, now we got a couple things here, and this obviously is the wishing and hoping and praying part. And this is the final webinar for today, and I really want to thank you for joining us. And but stick around here a minute because the good part's coming. We start again tomorrow at the same time. There are 7 of them tomorrow, and I do believe that Gregory McLeod is kicking it off with his Pip and Run. So he's going to talk about scalping and short-term trading. Always a very, very popular webinar, so you want to join us from the get-go if you can. And one thing we've got, Dan is on here, and I think he's going to do our raffle, our $500 account raffle. We're going to do one today and for tomorrow. And also, everybody in attendance today, we haven't talked about this, but everybody in attendance today will have access to Aura FX's proprietary price action analysis, which is valued at $700 per year, and more details after day 2 on this. And of course, we're going to be asking for feedback on the boot camp and maybe what we can do different, the good, the bad, the ugly. And those people are going to receive open up a live account, receive $50 to start trading, with Aura FX. Other than that, I thank you very much for joining me. I think I'm turning it over to Dan here. Dan, you with us?
Good.
Oh, okay. So
thanks, Tom. Okay, folks, I hope you had a great day today. I know a lot of people were able to make it into every session, and some people were able to come in for just portions of it. We didn't record every session, so ultimately you will get them. So that's something to just know if you